Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, July 30th, and it is a little in front of 11:30 a.m. here on the East Coast. I'm Wayne. My partner Ryan's working on the market outlook overview for the week that will be coming out a little bit later, as always. And let's get rolling on our disclaimers, and then we will get into our typical fare. Going to try to expedite that. I understand that less details apparently are what the majority prefer, so I'll try to expedite these from now on. That's runs counter to how I look at things, but that's the way it can be, I guess. So we'll do what we can to sort of shorten things up here from now on, and might have to do maybe a separate video for those interested in covering the tabs, which we'll do briefly. Here's our trusty intellectual property rights notice, if you could memorize that. And then finally, we are into a quick review on things. And so I'm just going to leave this up there. All I'm really going to focus on from last week's stream of consciousness discussion is the current assessment, where I highlighted in red, right? So the sweet spot, which we'll review, is about to be in the book. I'm sorry, not red, excuse me, orange. The sweet spot's about to be in the books. The VIX seasonality third year still tracking, which we'll cover. Again, I would suggest that you kick the tires on the Phoenix service for volatility positioning. It could be very important going forward at a juncture like this, given where the VIX is and given where all the things are that we're going to look at, that kind of the greater scheme that we're in right now. And then the big questions to me still remain. We don't know if the gang has already ran them too far. And we'll maybe see gap up exhaustions this week, especially with Apple and Amazon and a lot of other, massive deluge of EPS coming out. Or if there's going to be this gap down buying, right, effect, which we've seen some of as well, or sell on news, period, right? Because earnings season will have hit its peak. The big dogs will have reported, and then, right, we'll talk about that briefly in a little while. And then I'm still wondering if they're going to be able to put together the take your breath away final squeezy melt move to the upside, or, right, whatever the case may be, if things are just kind of there in terms of, yeah, there was a beat or this or that, and it's nothing special, do they just start taking profits? And that would, of course, dovetail nicely with the third year of the presidential cycle sweet spot retiring, as we'll soon see. And then, as we noted last week, really, the EPS reactions were likely to dominate the closing of the sweet spot window. That's unofficially going to happen, I think, this week, but for sure. So with that, let's then move over to this week's, and these are the things I'm going to cover. I'm going to leave that up there for a little bit. I'll just leave it off screen and we'll cover that. So if anyone wants to take a screen cap or something like that, they'll have it for when we review things. But on that note, I'm going to briefly stop the share now, and then we're going to recalibrate here a little bit and get things moving. So let me move this off screen so I can discuss all these points. And I think the first thing I'm going to do is just cover the review and summary. Let's get screen number 4 shared. And then now that we're sharing again, we ought to be able to find this. Where am I on? Yeah, I think I've got it here. I think I've got this here. Yep. So I want to. That is not it. Every time I think I know where I'm going, there it is. It's this one. So I'll go into these. But in terms of the tabs that I'm talking about, these are the tabs that I'm going to cover in this browser window. And this is going to be a quick tabs check in the interest of time. But anyway, just a review and summary for this week is, I think last week was about as we expected, right? The news and EPS reactions did ratchet up volatility. Ultimately, right, the gang was able to hold the spies and Qs at trend, which they've done many times. They did not crack, right? They were tested again, did not crack. That's backed off the short-term overboughtness that we had in place. But again, I think bigger picture-wise, you're still overbought. You're just not extreme. So I've been saying this now for a couple of weeks, but right, the whole point here is to try to be as objective as possible so that we can make the most out of our market assessment, and then again, not be surprised by anything and be willing to go with things until we see signs that they're turning, or maybe they actually do turn, between one week to the next. But the quick tab check, quick quick tabs check consists of looking at the percent of stocks above their 20-day moving average. We'll start with that, right? So here we are. I'll bring a little more history. And as we noted, it did get up there for sure recently, right? Last week, I should say the prior week, but it wasn't really super extreme. So there was more room there, but they did back things off nicely, and they kind of finished right about there. So not a lot to say other than you just can't rule out that there's more to come, right? And also you can't say, well, no, there's no way you keep backing off from here. So it didn't get extreme to have high confidence that you're like, oh, this thing's done, right? Where it was up at super high levels. So this is similar on the percent of stocks above their 50-day moving average, where very close to some of the higher levels we've seen. But I would call more normal markets, if they even exist anymore. But this is still nothing compared to what we saw right with the COVID situation. The post-COVID response was, remarkable with what happened with the market. And so these are almost like anomalies, right? So overall, you were getting up there, which we've noted. And I don't think that you got as big of a push, right, in terms of going to the upper echelons like we saw way back in here in terms of percent of stocks above the 200-day. So you were getting up there. You got to say, well, that's pretty up there, right? We will say that, but it's still not extreme, even from other market peaks that happened prior to COVID. You really weren't there. So again, I would say that you still have room, right, to put more together before you crack. Doesn't mean we will, just trying to get that general assessment in place. The CME, right, this is the Fed watch tool that we've been using. And we've been noting that rates were set to go up as they did. And so we're going to stick with that, and the rest of the year pretty much looks like it holds steady, maybe goes up a little bit. I don't want to belabor that. But the point I'm making is what I mentioned on Cocktail Hour, where with respect to rates, remember, a lot of these bulls were selling everybody on the idea that we would pause maybe in April or May and then start maybe even tailing off by then. But interest rates have only gone up since they started promulgating that stuff, and those rates apparently are going to stay higher as a result of the 2 to 3 increases we've seen since that chatter really ratcheted up late in the spring or earlier, I should say, late in the winter, more early in the spring. So the higher rates for longer was not part of this plan, and so stocks have roared on this idea. At least they initially were doing that to some extent, and that's just gone. It's been undercut, right? So that doesn't turn out to be the case. Again, as we've been noting, you're still operating in the extreme greed range right now. Again, very faulty. You can make all kinds of criticisms of what this is, but at least it's something we can go to for a quick check. And here's the timeline. You can see that you're rolling over a little bit there. So I think you're not super extreme, but you certainly got to a pretty strong point up in here, right? So you can't be surprised now if you're in that corrective area. And again, that really coincides with how the bullish sentiment, according to AAII, really got a little wacky last week. It went, right, look at that big jump from 712 to 719. So that really got a little absurd there. In the short run, backed off last week, but they note that, right, that optimism is back within the typical range, or its typical range, after its unusually high reading last week. But again, the optimists are back. The historical averages, you're still well above those in terms of bullishness. So that really dovetails nicely with this rate here that we've been tracking for nearly the entire year. We're in the 3rd year of the presidential election cycle. And you can see, right, we remind viewers every week of this, but this is the year that produces the best returns. They're nearly double next year, which happens to be the 2nd best year. But right, if the market continues to trace out the way that it has overall, right, historically, you're going to see some volatility pick up and over the next few months, more than likely, and then finish the year strong. And then the gang keeps that going right into the election and even beyond. So that's just the way that it is. I'm not so sure that that's going to happen at this point. I'm not really going to be, excuse me, dependent upon this, but as long as it tracks, we could find it useful. Now, within that 4-year cycle, excuse me, we have this sweet spot that we've been referring to. And that sweet spot really begins to kick in somewhere in the earlier part of the fall, and then kind of brings you into year end. And then you just keep going. And you could see that the green takes you a little bit past, I think, mid-year. Mid-year would probably be a little bit back here. So which again puts you into July. And you ought to see, right, sort of that, as we noted, volatility picks up. And that wouldn't be crazy, right? To finally see some more volatility, get a break in the trend. And then you end up, right, in the end, you end up with a market that's hopefully still nice and tradable with some good movement back and forth. But in the end, the gang does what the gang typically does, and they get a hold of the market after finding a way to support it. And then they rally into year's end. And then that seems a little excessive and it seems artificial because it's all about them getting their bonuses. But then that tends to continue, right? So this is the game that they'll play. My opinion is that the Bulls will continue to play the game. They're the last to really want to admit that things are not as they seem in terms of all is well, all is normal. They're always making that argument, right? Oh, well, this should happen until it's the same with the media, financial media, in my opinion. Until they're forced to confront reality, they just won't, right? And so even if there are some really ugly underpinnings to what's been happening here, they'll ignore that until it's even beyond obvious to anybody that pays attention to the market. The average armchair market quarterback will see that far before the financial media and Bulls are willing to acknowledge it, from my experience. This is our reminder about the seasonal volatility situation. So remember, this makes sense as well, right? That you would expect the VIX to really start picking up, or volatility products, or just volatility overall in stocks. That's why I'm saying maybe kick the tires on Phoenix, where Ryan goes through a myriad of ways that you can handle going long vol in a strategic way. So just something to think about. And then these tabs, much shorter, again, trying to keep things short. This is the one I was looking for. I found it. I came across this. Someone asked in cocktail hour if I thought that this was all retail, or a lot of it was retail, or possibly all institutional, that was driving this market up since the October lows. And I just said, to me, it's that I don't think that the public can move a market up. And the Qs rallied from low to high, roughly 50%. I mean, that's an incredible rally in 9 months for an entire, I guess you would say, an entire index, right? Or index ETF. And the other index ETFs are no slouches themselves, especially the spiders. So I don't think this, I think, in fact, from what I've seen on my charts and some of the numbers that I crunched that Ryan's helped me work out for trying to estimate what folks are up to in terms of positioning. I think there's a lot of cash that's just flooded into this market. And I think there's a lot of people along, and you could see that, that'll all be great if it works out, right? But at the same time, right, if their scenario of, things are soft landing and doesn't work out, it's a problem, because they'll all be heading for the exits, and they've all gone in a really big way, like it was the greatest buying opportunity of a lifetime, starting in, with the October lows. So you could see that the active managers have a great deal of exposure again. So they went from being, less than 20% to above 100%. So they're leveraged long right now. So there you have it, right? I think that's a pretty good answer right there. So I just wanted to demonstrate that. So let's cover things quickly. Let's talk about this week's stream. Again, we covered the review and summary pretty quickly on that one. So the current assessment is I just wanted to reiterate that in terms of current assessment, the gang largely works their magic in accordance with the economic calendar, the various calendars, political calendar, the Fed calendar, earnings season. And remember, these are all just my opinion. I think news can be made to trump charts. I mean, that's what I've seen. So I've seen incredible, technical setups just get trashed by news. And so too many times to say, no, the charts win out. It's probably really that ultimately the news has the final say over the charts, unfortunately, because I wish it were charts, because I feel like I have a much better chance of being on the right side if I'm reading the charts right. And I think I can do that consistently. Guessing what news reactions will be and what's coming out, I can't do that very well. I don't have the resources to do that. Anyway, I still think there's more more potential on the chart in terms of room, right? So if you just look at this one right here, the Qs right now, the Qs to me they've got that little bit of room. If I extend this resistance line for this channel that we've been working in, this uptrending channel that's been in place for a very long time, and I just sort of extrapolate that we go on a 45-degree slope, that almost takes you back towards, I think, the all-time highs in the Qs, right close to it. Let's see if I can just get a little more data in here, and then we'll be able to check this out. But I'm pretty sure that somewhere near that 408, yeah, it actually 408.71, right? That's where I should have known that, because that's where I started my fib retracement. But look, they've held trend, right? So that's what I'm saying. I can't rule out one more round of squeezy melt. You're not extreme on things. They've got Apple, they've got Amazon. I mean, Apple is just the big dog of them all. And if they can move that up and move other things up in sympathy with Apple, that could create the final sort of buying crescendo. I don't even want to say that'll be it, and then we immediately return to a bear market. I'm just saying that could be where, they blow everyone's mind and you're right back at the all-time high in the face of everything. And I think that would take people's breath away, because I think a lot of people sense that there's not a lot of really great things happening, mainly, right, that interest rates are much, much higher. Inflation remains much, much higher than when you put in the all-time highs. In terms of where you were, in terms of the trend of like where you were going. So back in here, right, in late 21, a lot of people were not factoring in higher rates to the extent that they have to confront them now. And a lot of the inflation, that wasn't really as pernicious in their minds at that point. And now I think that's the case. So to me, again, the market doesn't have to make sense. We know that. We got to trade what's in front of us. We know that. And the reality is that these guys have been able to, every time, right, they've swooned down after a nice run, they've found support at the 10, the 15, or the 20, which is one of the reasons why I run those simple moving averages. It's always been kind of an obscure kind of thing to me in terms of like maybe more of an odd thing. Like, why should that even matter? Like, that I'm calculating the price over the last 20 periods. And why should it matter that it stops at that average price over the last 20 periods now? But this is the behavioral aspect, I think. And people just react that way. People like to see things hold trend, and they assume the trend is going to continue. And let's face it, a lot of trends last a lot longer than a lot of people would initially believe, myself included. So that's why I think being a trend follower, a trend trader, makes a lot of sense, because these things do tend to last, and you can either ride the whole trend, or you can go back to the well and just catch the market or the stock after that corrective activity's largely played out, and it looks like it's held support and now it's reasserting itself. And if you keep doing that in a bull market, or at least a market that continues to act bullishly, you can do very well, right? So we all know that. So the problem now, though, is the sweet spot that we looked at, even though there's more room, and I just acknowledge that the sweet spot is gone, right? It's after this week, it's really in the books where you should see volatility pick up, other than the fact that I think the dog days in the market are definitely in August, and the second half of August is some of the boring to the point, which if you were an on-floor market maker like Ryan, myself, Greg, were, you would get bored to tears practically, because it's your business and you're trying to make profits, right? And if there's not a lot of opportunity, what does that do? Well, people that are used to trading very actively end up in a situation where they're forcing a lot, and then you kind of have to learn not to do that, right? Because forced trades just usually don't work out overall, I think, on balance. Like, you have to wait for good setups and good environments, and choppy ones are, some people specialize in that, but that's not really my forte. Mine, I'd rather trade in a strong trend one way or the other. Ultimately, I'd rather be in a bull market than a bear market, just because the rising tide lifts so many things and lifts them strongly. And I think bulls can afford to be, wrong a great deal of the time and still do well. And bears can be dead on right, but just the mechanics of the market can work against them viciously. Just the way that it is. Just my take on it. But anyway, so with the sweet spot fading away, I did notice that the soft landing crowd has been doing the victory dance already. Not all of them, but there's a lot of them out there doing the victory dance. Like, oh, we're going to get this soft landing. I think that's very premature. I'm not buying that yet. I hope to be wrong, but I'm just not buying that. Anyway, the dollar and the TNX also, they're looking a little bit perky, right? Where they started to perk up into levels that are maybe, right, if it can break free of here, right? Let me just try to get this. If this can break free of here, right, and break this trend, and the dollar leaves more or less downtrending corrective action behind, that would not be good for the market. And you can see it perked up. I think what's obvious that perked up even more is the 10-year yield, the TNX that we track. And so that is perking up, right? That trend, you can see that trend is more of an uptrend, and even the SMAs are largely upsloping, right? So I'm not going into deep analysis here. I'm just noting that in the short to intermediate term is definitely up, while longer term, right, you're flatlining. But this is starting to put a picture together. Remember, if rates are set to go up, inflation is a little sticky, it hangs around, you could see a retest of that. These things would not be good for the market stocks, right? That would be probably happening while the market's in trouble. And so, right, it's worth looking at this to say underneath the surface of a market that's barely off the recent highs, there's a lot of things that are happening that are not all that wonderful, right? So this is why we do what we do, just to not get caught off guard, right? Keep your wits about you. Keep proper preparation prevents poor performance, basically. That's why we do what we do. Here's the VIX, right? Started as it often does, started to get going, and then boom, that was over. It happens so frequently. But now, right, as Bill Johnson and Ryan, even I chimed in a little bit, I think it's a smart time to position yourself long volatility. I would position myself I would probably own a ton of November vol, because that's also going to be when it'll encompass the earnings reactions for the next quarter. So you'll have that. You'll also have the October risk that has crept up in the markets over the years, and you won't be holding over any major holidays because that stuff will die off in front of Thanksgiving, and of course all the December holidays. So I love November as a month to own if we're playing options monopoly. I also love February and March, and I like May as well. And the rest of them I tend to sell against those cores, and sometimes January because you get stuck with leaps. But anyway, there's the VIX and the TNX and so on. Bottom line is, right, that I still think that if you look at it overall, you're still, to me, like you're in the later innings. I'm calling, remember, we've been rallying here for about 9+ months at this point. So yeah, I think if you look at each month as an inning, I think you're there. I think it's getting close. And again, I'm not predicting a cataclysm, and anything can happen. I'm just saying that if there's going to be a time on the calendar after all the earnings reactions are over and done with, it would make sense for them to start to, the volatility should pick up as per the normal third year seasonality, really every year seasonality in the next few months. These are not good months typically for the market, August and September. They're not some of the better months historically. So if you're going to have your corrective activity and then finish the year with a window dressing extravaganza, right, get all the overboughtness and all that out of the system. In other words, like, it would be good for bears and bulls, I think, overall, if there was some corrective activity, and it should happen soon. Again, we're not diving in as bears. We have to wait for something to crack, and literally nothing has cracked on these things in the end. They were able to hold these things. One little dalliance below a support line does not make a crack, right? You need to see something really break, and you haven't seen it. So even the support lines held, the rising 15 in red, 20 there in light blue, these have held. But notice, right, that we came out of a consolidation, and then we may be steepening a little. So if you kind of get that final steepening into maybe an attack on the all-time high near 480, again, not saying that happens, but you can't rule that out of the realm of possibilities. Your Bollinger Bands would be super wide there, something that matters to me, that when you have a Bollinger Band excursion and the bands are super wide, that to me is a real warning sign. So if they do pull that off, I would think that would be a tremendous short-term selling opportunity. Again, once you finally see the whites of their eyes and you do see some support cracking. But again, don't want to get too far ahead. I think you have to just be honest and say that the bottom line is that with Apple, right, with Apple reporting, we saw some UOA in here, and I've got a bullish idea in place. I renewed one. I had one in there and I renewed it with another fresh one. So we have those ideas in place here, and Apple too has room, if you ask me. And right, it got so close to 200. It would be very unlike the gang to have a chance to print 200 on Apple and then not do it. But it could happen, right? I don't know. I don't know jack about what Apple's going to report, say. We can guess it's going to be an AI fest, things like that. But you know the rest. But with Apple and Amazon set to report, I think you have to be ready for anything at that point. Amazon also have a long idea on in there that came in. So again, that would be an attempt to. This got to crack a little more of its trend, but the 50 was right there to kiss it and then send it back into the uptrend, right? So for now they've held, right? For now they've held. But what I would note, and I'm going to just note this technically before we wrap everything up. What I would note though is that there's been a little bit of divergence that's been emerging here, right? So this can persist. So that's why we haven't gone shorts, because we've seen some divergence. We're trying to be objective and wait for a crack, or before we buy our puts. Come on, Thinkorswim, work with me here. But I just want to show everyone, right, that the SPY has made higher highs, but we continue to tail off overall. So it doesn't mean they can't do one final push up. I'm just saying that I always kind of keep that in mind when these things become a little aged, that it's just not getting the same oomph. Certainly that's the whole point of the Apple, Amazon, especially Apple, that if you're looking for something with oomph, it doesn't get much better than that, or Apple with a beat and then extravaganza euphoria, or the Fed with the interest rate cuts out of nowhere. Those are some of your better things that can really launch a squeezy melt. Anyway, that's the big question, right? Do they launch one final massive squeezy move and then they really get full capitulation, and then there's no one left to buy right at that point because the prices are too high and everybody's already piled in? And then given the seasonality, et cetera, do you finally get some corrective action of a greater magnitude? So that's the thought. I still think that the closing of the sweet spot window that we're talking about here will be dominated by not only Apple and Amazon, but there's a massive, massive number of earnings that are being reported this upcoming week. I think this is when you hit the big crescendo. As I said, I would be at DEFCON 2.5, excuse me. I'm using a cheat code to go between 3 and 2. But I would be with an itchy trigger figure, because it depends on what these things do. If they can't work with, I don't know what catalysts are going to be there for them on the calendar, since the Fed is a ways away. The main earnings will have come and gone. Rates are stuck higher. I don't know what catalyst they could then roll out to say, look how, the latest shining, glimmering piece of distraction they could roll out at that point. Maybe there is something I'm unaware of. Maybe there's a ceasefire in Ukraine, which they've ignored, but I guarantee there'll be at least a minor celebration if that comes out. Oh, wow, that's wonderful, right? Even though they haven't cared about it, but just any and all excuses to rally stocks and, put the hurt on folks that are short or under invested. And this is what they do. So that's my big question, right? I think it becomes more of a sell on news if earnings are really a nothing burger. If the earnings are like blah, 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 then to me, I think it's time for profit taking. But again, wait for your trend to crack before you really get too over your skis, or get into Phoenix portfolio to at least kick the tires and learn about ways you can position yourself smartly, I think, for some downside vol that could really pay off if we do finally get a major crack at the but before the end of the year, or maybe going into early next year at some point. So I'm still not buying what the perma bulls are selling. I still hope to be wrong. I still don't see, bottom line for me is I still don't understand how anybody could think that such a rapid increase in rates and along accompanied with a massive run, right, and prices higher, that people are going to be taking out loans on items and that are going to effectively, right, keep this economy humming, when the kind of debt that's and the monthly payments are just extraordinarily higher in a very short period of time from where they were just a few years ago. So when you pay top dollar and then you also get crushed on rates at the same time, to me, I don't see how an economy that's so dependent on interest rates ends up weathering that, and that turns into a soft landing. And I've been saying that since before the bottom, after the bottom, through all the rally. So again, this is exactly why, like, that's my simple case. This is exactly why we try to be objective and follow the charts, right? And the charts really bottomed, and you saw market breadth and everything really start to improve and head in the other direction a little bit. A lot of the early leadership was from just a few stocks, but bottom line is that they jammed and kept jamming, and more things have joined this. So the rally's gotten the support in terms of breadth, right? I can't deny that. I just feel like there's something about it to me that feels very premature. And I hope to be wrong, but I feel like there's been a lot of people piling in as if it's the same old, same old. I don't think it is still. I just don't think it is from all the stuff that I review and Ryan and I share and back and forth with each other. I just don't see how we're already out of the woods and everything's copacetic, but we'll see. Again, another thing I just hope to be dead wrong on. Regardless, we're trading the charts. The charts are what dictate what we do. And right now, right, we're not in an easy spot because we're not in earlier stages and we're in latter stages. So as long as it holds trend, you just keep going with it. You hold your cards close, right? You play smart. You play with great discipline on the long side until that trend is under assault, right? And if you have a big day where you're up 1.5% or 2%, then you take those profits and you roll aggressively. That's what I would do. That was proven this week too, like where you had a big gap and then they laid into the market here, right, on Thursday. So you just got to be smart, and that's the thing. Like, people want one size fits all, but everything to me is all about the environment you're operating in, your strategy selection, your sizing, right? How you manage things aggressively or more patiently. That all gets answered to me by what the charts are saying and what stage you're in, where you are in the grand scheme. And I just feel like for this rally that we've had, you're in the latter stages in my mind for sure. So I'd be surprised if they could push this too much beyond the all-time highs and just keep going. I could be dead wrong, but I'm just saying, without a decent break first, I'd be very surprised if they're able to do that, just keep going, and then all the way into year end. It could happen, but I just don't. My sense is that a lot of things say that doesn't make any sense right now at all. So I'm very much on the side of no, there should be some. And I don't mean anything great. I'm talking 3, 4, 5, 6, 7%. I'm not calling for anything like that. I don't really make calls that way, but I'm just saying, like, I don't, in my mind, unless something changes in the news landscape, they're not going to let this thing crack that big. And then finally, right, that's just a reminder, we have to stick with these charts, and they're still up until we've seen that improving breadth. It's the final point, and the bulls have been in control for 9+ months in the face of everything. And they've been very deft in how they've handled this, where they use their big name stocks and a big kind of meme, the AI meme, to create this buzz and have people take their eye off the ball. But this is absolutely what happens in every cycle I've ever been through in the last 30 years since I started trading professionally. It's absolutely what happens every time. And people get caught up in the hoopla. And, the thing is, you can make a lot of money in the earlier stages of the hoopla. You can even make a lot of money in the latter stages of the hoopla. It's a little bit harder, like I just said, but you don't want to miss out on the hoopla, but also you don't want to get caught holding the bag. So that's, again, why we do what we do. And so I think that's the best I can give you in terms of an outlook for now, right? Trend is still up, willing to trade it that way. Be smart about how you trade it. You start to see signs of it cracking, right? Remember, everyone's waiting for signs this thing's cracking. So you will not be alone. We will not be alone with our bearish ideas. So again, when you're trading counter trend and you're early, you're seeing a real rollover, you've got to be disciplined, get that quick roll in. And this way, if the scammers and jammers rip it right back up in your face, you could still eke out a small win, or at worst, a minor loss, and keep rolling. And that's the whole thing, right? If you can be smart and you stay disciplined, eventually you're going to catch the tiger by the tail with that short, and then you'll be you'll be really cranking. But as long as you don't get too hurt on the way up while the bulls are still in control. So again, divergence showing up, breadth kind of flatlining. There was a little thing I'll mention here in closing. I think it was somewhere around here. You could just see this is one of my breadth screens, and you could see, right, cumulative volumes continue to work up. Here's your McClellan summation. That's continued to work up. So again, that's another reason why I can't be too critical of what these guys have been able to do. But do notice that the McClellan oscillator isn't all that right now. And so that is kind of at odds with where it was on these prior highs, right? So knowing, right, that the McClellan oscillator is struggling a little bit, it's the first sort of signs that, hey, maybe between that and some of the RSIs, the overbought nature in the big picture, all these things that we are, again, this is what leads me to believe that you're more towards the latter innings of this, and that there should be some corrective activity in the near future. It's just a matter of when. And really just let the market tell you, right? Wait to see something crack. It could even just be a low. It doesn't have to be an SMA or something, or it doesn't even have to be a flat line or a support line. It can be a low that you think is important, right? It could just be one or two candles that you think matters. But if you get in and manage it with discipline, you'll still be fine, even if it doesn't work out. That's the critical part of the whole thing. So on that, I just want to say, I hope that something I share with you helps you out this week or some week in the future. I want to thank everyone for tuning in. I think you need to be nimble this week as usual, maybe even more nimble. Trade around those earnings unless you have high confidence, and just keep your eyes on things because we are in the latter innings. Everyone have a great conclusion to their weekend. Thanks for tuning in.